Hey guys, it's Nick. There are some definite cracks starting to show in this housing bubble we're in. And in case you didn't know, having multiple bids within a few hours of listing a house is not normal. Neither is offers coming in at 10, 20% or higher on run of the mill houses. This will not last forever and usually is a sign of a top, just like a blow off top in the stock market where everybody just has to be all in. But not everybody needs to own stocks, but everybody needs a place to live. So, is it different this time? Of course not. The first thing to realize is that houses cannot go up at these rates forever while interest rates rise because of inflation, yet people's salaries are not keeping up with inflation. If a house costs $1, then everybody could buy one. If they cost $1 billion, then no one can buy one. Whatever level of house someone could just barely afford 6 months ago is now out of reach because of a combination of higher mortgage rates and more of your monthly income going to energy and food increases. So let's take a look at the actual data. So, first things first, how much money do people have saved for down payments on houses? Well, let's take a look at how much they're spending on their credit cards. So, this is total consumer credit, which means credit cards, car loans, and student loans. During the pandemic, Americans actually saved $60 billion in this month, and now it's gone the complete opposite way. And this is a record high $52 billion total spent in March of 2022. And that is double the expected $25 billion they thought it was going to be. So the non-revolving credit, which is student and car loans, is $21 billion, which is the sixth highest on record. And revolving credit, which is credit cards, people paid down all of this, about $50 billion during the pandemic. Now they're adding to their cards like crazy. So February they added 14 billion, and in March they added 31.4 billion, which is the highest print on record. So not only are people not saving, but they are maxing out their credit lines, either because they think things are going to be higher in the future or because things are already so high that they need credit to just get by on their usual things like food, energy, and that kind of thing. And so here's a look at the personal savings rate. Again, it went up during the pandemic because of all the stimulus money, but we are right back down to that baseline level of 7% or so. So people's savings rates are down, their credit spending is going through the roof. And so let's see what this article says of the odds of regional home prices dropping over the coming year. And very low is this green, and that's most of the country, apparently, according to this article in Fortune. However, how CoreLogic rates home prices in America's largest housing markets: undervalued, normal, overvalued. Well, all of these markets are overvalued mostly through most of the country. So not only do people not have savings, they're increasing their credit spending, and all of these markets are overvalued. So here on Zero Hedge, they say there goes the housing market, and they say Airbnb co-founder warned, this moment feels similar to late 2008 when we started. And so they say declining affordability argues for a more pronounced impact. So here's the housing affordability index in dark blue. This is the impact from rates, and this is existing home sales. So here is the housing affordability. It is plummeting, and it's lower than even during the financial crisis, going all the way back to 2002. So here, John Burns Real Estate Consulting provides a monthly snapshot of more than 300 builders across the country. Here's what they say. 1, demand is slowing, namely entry level, due to payment shock. 2, investors are pulling back. And 3, the ripple effect of rising rates starting to hit move-up market. So here's a regional breakdown of some comments from different builders. Dallas, interest lists are sinking or buyers are truly pausing. Houston, many first-time buyers simply no longer qualify with the increase in interest rates as their debt-to-income ratios get out of whack. Seattle, paused by a large population of buyers. To achieve our desired sales pace, we had to make price adjustments, rates starting to knock people out of qualification. Atlanta, seen a decrease in the number of potential buyers who are participating in best and final offer on home sites. So those bidding wars are starting to cool down. And so there's a big disconnect between home builder sentiment and home buyer sentiment. Home buyer sentiment is down here at 40, the lowest it's been since 1990. And home builder sentiment is still the highest it's ever been. So they're going to have to meet up someplace eventually. And just to show you how big a difference a few percentage points on a mortgage makes, let's look here. The rate was 3.59 on a 30-year fixed in January 21st, 2022. And now we are at 5.57, so about 2 percentage points higher. So let's see how much house somebody can afford if they make $5,000 when interest rates are 3.5 versus 5.5%. So these numbers were supplied here. I'm going to leave them the same, just change the interest rate. Let's see. So with these numbers, they say you can afford to pay $1,400 a month on your mortgage, which means you can afford a house up to $250,000. Now, this person who could afford $1,400 in January is now looking at 5.5% interest rate. Let's see what that can buy him, that same $1,400. So at 5.5% interest rate, that same $1,400 gets you only $202,000. So a $50,000 difference in housing price. So all these people who could afford $1,400 before were looking at $250,000 houses. Now they could only look at $200,000 houses. So guys, if you feel like you must buy a home at any price because they're not making any more land and there's a housing shortage, you might want to take a step back and maybe build up your cash savings. If rates go high enough, it could put a big downward pressure on housing prices. So you might be able to buy a house for cash or at least put a bigger down payment on a house that's a good amount cheaper than they are right now. You could have a higher mortgage rate, but a lower purchase price. And remember, during the housing crash in 2009, many houses were 50% off or even more, and nobody wanted them, or if they did, they couldn't buy them because they were already stuck in a house worth much less than they paid for it. Also, they had no cash because their stock investments were also down 50% or so. So guys, don't think this can't happen again. If I were you, I would keep some cash available for when the bargains happen because they always do eventually. I hope you liked this video and I'll see you in the next one. Thanks for watching, guys.